Hello, everybody, and welcome back to the Forte Financial Mortgage Group podcast. And this week, we are back with our first-time home buyer, Matt, to discuss a couple of further options and new things that have come up since the last podcast, which we thought would be great education for our viewers. Matt, say hello.
How you guys doing? Thanks for having me again, James. Appreciate it.
I appreciate having you because having a real first-time home buyer as a real example, someone who's looking to get into their first home, it's authentic. You know, this isn't staged. This is you're truly looking to get into your first home. And since the last podcast, let's just get right into it. One of the things that we went over was that, you know, and this is something that we preach, and you can go back to our previous podcasts for the viewers, that we talk about you can actually afford to buy if you can afford to rent, okay? And, you know, there's a lot to it, so go back and watch those podcasts, how we give some specific examples of a similar property, you know, whatever, if it's a two-bedroom, one-bath condo to rent versus the same exact type of condo unit in a similar complex to buy, how you can actually buy it with the same or less money out of your pocket as you can to rent that and have the monthly payment be the same or less, not even take into account those tax deductible pieces like the mortgage interest and real estate taxes. So go back to those previous podcasts if you want to see those. However, what was great was all the feedback. We got a lot of feedback, Matt, from that podcast with a lot of negative comments, which was great. Truthfully, it's great because the negative comments, oh, that's not true. You can't buy. It costs more. You know, there's nothing in this area. There's nothing on the market. They're cutting the lawn and all these other factors that people brought up, which I appreciate. Truthfully, the feedback helps me educate you guys. And so what I thought, Matt, was we would discuss, and also in doing our further discussions out of the podcast with some of your goals. You know, one of your concerns is, James, right, what about moving out of the area? I don't know if I want to buy. Why don't you talk a little bit more and ask some questions about that, so we can dig into.
Yeah, definitely. I think a lot of the concern is people don't want to buy because they don't want to be stuck in the area they're in, and I'm kind of in the same boat. I do want to move eventually, but, obviously time will tell. I can't tell when I want to move. So that's a question that I had because I know there's different types of mortgages for if you're, just buying a home for yourself or buying a home as like an investment property. So I guess the question would be what would be the best route if I'm in a situation where I might want to move, but I want to buy a home? Could I buy this home, live in it for a year or two, and then if I decide to move, use it as a rental property? Or how would that work?
Amazing question. Thank you, Matt. And this is actually going to roll right into one of the specific detailed examples I want to go over today. So first and foremost, you just hit the nail on the head. What you just said is exactly correct. If you buy a house, condo, whatever it is today, as a primary residence, you put, little to nothing down, you get in, you move in. Let's say you move in and 3 months later, you have a neighbor that you don't like and you don't want to be there anymore. You don't have to stay there just because you bought it as your primary residence. Things change. People's circumstances change. You're not required to live in it for any certain period amount of time. The point is, it is your intention, and part of what you're going to state and sign in your paperwork is that you intend to move into the property within 60 days. That's typically, for most loan programs, what they want to see. And as long as that is your intention and that is what you do, once you're in, if something changes, that's okay. Life happens. There's a million reasons. There's no penalty that says, if you move out within a certain period of time, we can foreclose or you're in default. And no, that's not correct at all. So first and foremost, you can buy a house, condo, whatever it is, co-op, move into it, live in it for a very short period of time, and move out if that is what you desire. And that is what life changes. You can absolutely do that. And that's an incredible way really to get your first investment property with minimal down, because let's just talk about that. You said different types of mortgage for different, yeah. So getting a loan to buy a primary residence versus a second home or an investment property are quite different. Investment properties require a lot more down, and the rates and terms are higher, worse. So a primary residence loan is much more desirable. So it's a great opportunity to get your first investment property by buying a primary residence that you actually move into, live in it for a period of time, and then rent it out and move on. It's a great way to get a better rate deal and less down payment. So let's talk about, some of the feedback we got from the podcast was we can't afford that. There's no houses here that we can actually afford per month like we can by paying rent. It's not available in our area. And I hear that a lot now. So I'm like, okay. First off, viewers, I just want to say I agree 100% that today buying a house, compared to the average income and inflation and taxes is significantly more expensive today in 2024 than it was 5 years ago, 10 years ago, 20 years ago. It gotten exponentially more expensive. So yes, it is definitely reality. However, it doesn't mean that there's not creative ways to make it happen. And I have one example. I have one example, and I'm going to share with you, Matt, and viewers, on how you can actually buy a house and have your monthly net payment be less than rent. Less. Significantly less. And in reality, it can literally be zero. So let's talk about an FHA loan. So what sparked this example in particular is I have a customer right now in Danbury, Connecticut, who's buying a 4-family investment property. He's buying it as investment. He's putting a lot down. However, this property sparked an idea from viewers, thank you again, with saying, I can't afford. I'm like, hey, FHA, which is one of our loan programs, they will allow you, Matt, to buy up to a 4-family house, okay, up to 4 units, 1, 2, 3, 4, with only 3.5% of the purchase price for a down payment, okay? And as long as you're going to move into and live in one of the units. So I'm like, wow, in this example, now listen, this is a pretty expensive house, but I just listen to the numbers and details, okay? The purchase price is $670,000, okay? Sounds like a lot, right? Everyone listening is like, I can't afford a $670,000 house. I'm sure you're thinking that. However, if this house, right now the current rents, they're all 2-bedroom, 1-bath units in Danbury. Each of the 4 units is rented out for $1,500 a month, okay? So that's $6,000 that this is generating, okay? If you wanted to buy it, okay, you wanted to live in one of the units and rent the other 3 out, you're now collecting $4,500. Now that's assuming that you can't get more. I think the rents are low, knowing the market, what other investors of mine that I do loans for are collecting. I know that it's probably a little low. Okay.
If I could tap in,
yes,
I pay
please.
for a studio apartment, small little, 400 square feet. I don't even know what it is. $1,645 before fees. I have to pay amenity fees after that. My electric, everything. It comes out to about $2,000 a month. So that's just to put it into perspective that $1,500 is way low because you have your own section of a house. You probably have a washer dryer. And if it's shared within the house, you're not sharing it with 500 units. You know what I mean? You're shared that we have, per floor, we have 5 floors. Yeah. So yeah, obviously, we have 3 washing machines per floor. I can go floor 2 where I'm at. Yep. It'll be filled. Floor 3 filled. I've done it. I've gone all the way up to 5.
So, well, there you go. There's another pain point.
It's terrible. And people are gross. They keep the washers shut. Mold builds up, and I don't even use them anymore because it's disgusting.
And typically with a 4-unit, to address that, each unit, it's like its own house. They each have their own washer, dryer, and their own unit. So, yeah, there's another benefit right there that I didn't even think of. But and in any event, so now in this example, if you wanted to buy this house, okay, you would need 3.5%. The biggest pain point here will be if you can come up with the 3.5% down payment, so on a $670,000 house, 3.5% comes to $23,450. That is a lot of money. Okay, so this is, but again, this can be all gift. You can get a gift from family for this. With an FHA loan, they allow you to 100% of the down payment can be gift. Okay, and as far as closing costs go, that can all be built into the purchase price. With what we call a seller credit, which is something the realtors would help facilitate. So in essence, you're basically financing the closing costs, so you're not coming out of pocket with any more than the 3.5% down. Okay, so let's talk about that right now. These are all real numbers, and this is a real example. An FHA loan right now, a realistic rate we could give you, right, would be 5.5% in a 30-year fix. That's a very realistic rate right now, which, by the way, is high right now because rates have gone up a little bit with all the recent election stuff, with markets going crazy, inflation fears, and stuff like that. Rates have gone up, but the expectation is, and the forecast from the Fed, rates are going to continue to get cut. And I think, once things change over next year, one of the focuses will be helping, homeowners, and figure out how to get these mortgage rates down. So, but the point is, as a 5.5% rate right now with 3.5% down, principal and interest payment on that right now, Matt, is $37.34 per month. There will be PMI, monthly mortgage insurance. All FHA loans have mortgage insurance, and any conventional loan where you put less than 20% down, you have a mortgage insurance. So in this specific and exact example, that monthly PMI is $295 a month, and the taxes on this property are $7,416 a year, and we're estimating homeowners insurance to be about $3,000 a year on this, which is realistic for that property in this area. So that's $250 a month. So, we came up with $868 a month for taxes and homeowners insurance. So that gives you a grand total monthly payment with everything of $4,898 a month. Okay. Now, if you look at the fact that those 3 units, which are probably under rented right now, they've probably had those tenants in there for a while, and that's why it's $15. You're looking at $4,500 a month that you're going to collect from those 3 units. So if you subtract that off of your mortgage payment, that leaves you with $398 a month. That's what it's costing you to own, per month, a $670,000 house.
And you're not finding that anywhere in the country.
No.
You're never going to find that.
So people,
the
point is, okay, if you can't find something, think outside the box. Okay, now, how much money does somebody need to make to be able to afford something like this is another good question. Because we're giving you the rental income as income to you, and in our underwriting analysis, we're estimating for debt to income ratio, assuming you don't have much other debt on your credit report, maybe a car loan, a little bit of credit cards or something. Assuming there's not much else, you need to make about $80,000 to $85,000 a year, on paper, in order to make this specific scenario work. So not that many people in their head probably think making $80,000 a year that they could afford a $670,000 house, right?
No, absolutely
Would you
not.
think that?
No.
So this is one very creative way that you can actually buy a house and have your monthly payments actually be less than if you were to rent a similar unit. And guess what? Now you have control over who your neighbors are. If you don't, if you have a problem with one of them, you don't have to renew their lease. They can be out. Find someone else that you'd rather be in there. You're in control of that now. Okay? So if you're renting, you're going to have neighbors anyway, unless you're renting a single family house. Why not have control over everything, right?
Yeah, and if you're renting a single family house, I don't even want to know what that monthly bill is. It's probably
it's crazy.
In the high twos if I had to take a wild shot at it.
So how does that make you feel when you hear something like that?
I mean, something like that too. I mean, I think the biggest struggle for people would be making the $80,000 a year. I don't think many people make that, but that's where it comes into play. It's like, okay, you work a full-time job 40 hours. If you really want to buy a home, you have to put in maybe 2 years extra of some, pick up a job in the afternoon, go work it, save all that money because you weren't making it in the first place, and you're not going to spend money out on restaurants or whatever because you'll be working. And then in 2 years, you can now buy this property, however long it takes, whatever side job you get. You have this property. Now you can make money on this property. So you can make money, and then over time, as you make that money, you can reinvest it into a new investment property and then just keep that rolling over.
Well, that's the whole point. So my initial thought here is, a lot of young couples out there. I mean, a young couple is probably making at least $80,000 a year as a young couple, you would think.
Oh, yeah. I think
I mean, especially, so this example is in Danbury, Connecticut, Fairfield County. I mean, it's definitely the median income is definitely above that in this area. So the point is, if someone listening out there is in a much much less expensive area, this example is going to be much less too. So if you say, oh well, I make $40,000 a year, and that's maybe more of the median income in that area, then the reality is a 4-family house is going to be a lot less than $670,000. Taxes are going to be, everything's going to be a lot less. Rents will be less too, but it's all relative. It's a ratio. So the point is, it's going to work if you're in a different area because the numbers are just going to be lower numbers all around.
I think people too, they don't take into consideration like seeing your videos online, because obviously you have a few videos that went very viral. So I think that a lot of people don't take into consideration like where we are, where we're speaking upon. You're licensed in I think 10 states, correct? So that somebody in Georgia might see this and go, oh man, $600,000 house. There's no way I don't make $80,000 a year, whatever the case may be. But that's based on your area. So you should go out and look at, a 4-family home, maybe the same size square footage, and compare it to something up here. You have access to that online. So you can compare it and see and know that you're not paying $600,000 for the same thing we're paying $600,000 for up here.
Right. And the point is to give an example. Everything is relative. So again, if you were talking about maybe an area in Georgia, which is less, which by the way, we're fully licensed in Georgia. We do many mortgages, and actually, we're doing some mortgages on multifamily homes for a fraction of this in Georgia. So it's all relative. Are the rents going to be $6,000 a month for the 4 year? No, of course they're not. They're going to be a lot less, but it's all relative. That's the point. This example is just to illustrate, to educate, so somebody thinking I can't afford the monthly payment on whatever the mortgage is going to be. If you really feel that way, which I contest that. However, instead of fighting that and showing a million examples of, hey, here's the same condo, 2-bedroom condo to rent versus 2-bedroom condo to buy with 0% down, because you have the 0% down program where you have no down payment, nothing out of pocket. We're like, here's how much that costs to rent. Here's how much it costs to buy. Here's your tax deductions you have from the mortgage interest and the taxes. It's costing you less with no money down, where the rent is first month, last month security deposit. So it's actually costing you more to get in and more per month, and you have no ownership. But to appease the viewers who have made a lot of negative comments, oh, there's nothing like that here, this example I just provided is, you can't argue that. The only thing to argue there is, oh, well, in this example, I can't come up with $23,000. Well, if you're in a much lower area and you're in everything's less expensive, 3.5% down on $300,000 is going to be like $11,000. It's a lot less, right?
Yeah, and can't you get like you don't have to necessarily get, and correct me if I'm wrong because I don't know, but you don't necessarily have to get a 4-bedroom. What if you got like a 3-bedroom? Or a 2-bedroom.
You mean units, 2-unit, 3-unit.
Oh, yeah. 3-unit. Yeah, I should say 3-unit.
Absolutely.
And so now you're looking at, if you get a 3-unit as opposed to a 4, you're at $400,000. And then, you're making a little bit less, with, people renting and stuff. But at the same time, that's how you begin. You start low and then you end up.
We're just providing a creative solution to help you, viewers, whoever is listening, on another way you can truly do this. And in your concern, Matt, Eric, hey, James, like I'm definitely going to buy something, but I may move out of the area in 3-5 years, whoever knows, I don't know how long. Great. If you did this, you bought this, you rented out to 3, you're making money, and then a year from now you're like, I'm out. Good. Rent the unit that you were in, and now you're making $1,500 net a month on this thing. and it's paying all of your expenses, your mortgage, everything, and you're building equity in the house, you have a nice write-off on your tax returns. Like, it's a beautiful thing for you with minimal down, minimal investment.
And I wanted to touch on one thing, and then I had another question. So the one thing I wanted to touch on was that a lot of people have concerns about it's never the same because when you rent, you don't have to fix repairs, or you don't have to do any of that. You don't have to, mow your lawn. You don't have to do any of that. Well, I'll tell you what. I don't know what the case is when you own a home, and you can explain that to me. If there's like insurance for that or whatever the case may be. But I know, based on my experience from renting, we don't have a lawn to mow. We're still paying amenity fees for that. They got to mulch. They do whatever. It's not like they don't do the best job. And when I need a repair, it could be a week, 2 weeks. I could have no fridge. All my food's done. If you own a home, you could go get that in the moment if you could afford it. But, with renting, they say they'll fix it. But depending on where you live, they could be, a couple days, couple weeks. But there's so many problems because so many people live there. And obviously they're never going to tell somebody if they broke something, whatever. I mean, I got, a window that I snapped the bracket off of. I'm just going to tuck it up and say goodbye. So the next person will have to deal with that. You know what I mean? So you have problems like that when you don't physically own it. You take care of things that you own way better than you take care of things that you rent. It's like renting a car. Drive that thing as fast as you can. You know what I mean?
We're not advising you do that. But no, good point, Matt. And I think a lot of it is really different depending on what type of property it is, who the landlord may be, as far as those variables. But your point is really well taken. And when it comes to, first of all, people that are concerned about, if something breaks, you got to fix it. A lot of people are getting home warranties when they buy houses right now, which, I'm a lot of my deals that we're closing, the realtors are actually giving that to them out of their commission for free. I've seen that a lot, but home warranties are very cheap, where it covers all the mechanicals and electrical components and, fridge, stove, oven, AC units. Like, you can get those warranties really cheap when you buy a house. So you're not going to be out that money if something breaks. Okay. No matter what, you're going to have maintenance on a house that you own. Of course you are. It's part of owning a house. But again, all those things are relative to write-offs, and it doesn't matter how you compare. It's going to still be cheaper at the end of the day, unless something really major goes wrong. But if something major goes wrong, it's probably something covered by insurance. That's another thing. I've seen people, who they have an outdated house and their house gets destroyed by some kind of whatever, a tree falls on it or something. Their insurance just basically paid for a brand new house for them to repair the whole thing, that they're not paying any money. So I've seen that scenario too, So it's all relative, but yeah, you do the repairs yourself when you live there. But in the example with leasing and renting out a couple of the units, just to go back to the example we used here, it all depends. Like, some of these types of rents, the tenant is paying for all the other expenses too. With cable and utilities and all that stuff. So it's all relative. But yeah, if things break, the owner is responsible to fix them. But if you have a home warranty, it's minimal.
Yeah, and that's also when you were saying like a tree or whatever falls, you don't get that in renting. Like, if my building collapsed, or here's an example, early last year, before I moved into this place, one side of the building, the sprinkler system failed. Mm-hmm. So it just sprayed everybody's apartment. And if you don't have renter's insurance, and you're pretty much screwed. But it's a point is that you have homeowners insurance, something falls in your house, completely breaks your house. In that insurance, will they cover, like, if you need to stay in a hotel, or if you need to, will they put you up?
Yeah, it depends on the policy, but yeah, many policies will cover that. Absolutely.
Plus, you're going to get the money, you're going to get it paid for, whatever. But as opposed to renting, that falls on your apartment or whatever you're in, the building, the house, whatever. What do you do? I don't even know because renter's insurance is very, very cheap. So I've never looked into a policy on that where if they would put you up, but I don't think they do. If you're out of a house, you're out. The landlords could take as long as he wants to fix the place, or the company could take as long as they want. So you might be out for a year, you might be out for 2 years, you might be out forever. You might just give up on it. You never know. I mean, obviously they wouldn't, but that's also another thing too, is when you're owning a home, like you're in for full control.
True.
100%. You're in full control of your stuff. And like I said before, you're going to take better care of what you own than what you rent.
100%. 100%.
Yeah.
Yeah. So, I mean, those are all good points. And you know what, maybe we'll have one of my insurance agent business partners on here to discuss renters insurance, homeowners insurance, what somebody who's buying a house should look at for types of coverages and deductibles, and what a lot of those mistakes are that people get, and some of the problems they've seen. I think that'd be a good one. You gave me a great idea for a future podcast. Is a homeowners insurance agent to discuss that and why the premiums have gone up so much, and and all that. So
I had a question about my friend recently bought a house, and I probably talked about it on the last time we talked. But he bought a house, and this is touching back on the whole first-time home buyer loan. He did that. He did his 3% down or whatever, and he intended to live in it. But he has a contract with them that states that he has to live there for 10 years. So he's thinking in his mind that, man, I can't leave this area for 10 years. And I was sitting there like, dude, like, what if you want to move? I mean, he's got a great job up here, but what if you want to move? What if you want to do that? And you have, now you're stuck for, he thinks to this day that he's stuck for 10 years. But I want to know if he wanted to move out, say a year from now or whatever, 2 years from now, and rent that out, how do they, because he said that they, when he first moved in, they were driving by, they were checking to see if his furniture was in there, if he was actively living in there. So what would happen if he went to go rent that out?
Okay, great. That's a great situation. That is a very unique first-time home buyer's loan that he got. It is not the type of first-time buyer programs that we do or we preach about. That's why I when we were talking earlier, I mean, you could buy it, you can move into it, 2 months later, move out. Our loans at Forte Financial do not have any of those restrictions. There are the types of loans that would have a restriction like that are some of the state-funded programs like CHFA. My guess is this is probably, if it's in Connecticut, it's probably a CHFA loan.
Yeah, I think it was because he was dealing with someone from the state and they had a certain amount of funds left, and so he had to get in quick.
Correct. And because we don't do them, I don't want to give any particular, although I'm pretty familiar with CHFA. But that is one of the reasons why we haven't partnered with CHFA to do those types of loans, is because there are a lot of restrictions where what we find is the restrictions that they put on you do not outweigh the benefits versus the programs we offer, which don't have those restrictions. Whereas those rates might be slightly better in some cases, the restrictions are not worth it, in my opinion, personally, especially when, we just refinance our people out. You hear us talking about it all the time. We refinance our clients for free all the time. So it's just, they don't outweigh it. But yes, people, be very, very careful about what type of first-time buyer program you're getting, because if it is a special state program, and especially if you're getting down payment assistance, which is some of the stuff that, we offer down payment assistance programs too, but again, they're not state funded with crazy restrictions. So be careful about that. And in his case, I don't want to say what CHFA would do, because I'm not CHFA and we don't do those loans. But yeah, I mean, they can certainly try to come after them and any down payment assistance money they provided. There's a lot of different things they can try to do. So that's a very different situation that I don't want to really comment much further on, because we don't offer that. It's not what we do.
Well, I know you don't want to comment much further.
No, I will.
But this is going to be related to you. So say someone, I mean, I'm sure there's many, many, many people out there that have that CHFA loan. Mm-hmm. If he were to decide right now, like, I realize that this might not be for me, could he do something with you? Could he come to you and
definitely,
refi or anything? I don't really know how that works.
Oh yeah, no, we've refinanced people out of CHFA loans all the time.
Okay,
absolutely, we can do that for sure.
Awesome. Yeah.
Yep. So yeah, that's those are all great questions. again, people, the point is to help you guys buy a house. Your feedback, even the negative comments are great because that helps me really see what struggles people are having and how we can help educate further. I think getting a homeowner's insurance agent on here would be really helpful. I know a huge concern that a lot of renters have right now is the cost of homeowners insurance, which, especially like in Florida, states like that have, not even doubled. It's times 4, in some cases, just condo association fees skyrocketing, stuff like that going through the roof. There's a lot of concerns I know people have. So I think we'll do a future podcast with that. So stay tuned for one of those. And, we're going to have a CPA on here soon as well to specifically talk about the tax advantages of buying and put together some examples so we can show it. I know we talk about it a lot, but it's really, I think that those are some of the next things. What else, Matt, do you think would be helpful for you as a first-time buyer looking to do something to learn more about?
Well, I was going to touch back quickly on the whole tax thing. Mm-hmm. Like, people don't think that because you're spending the money now and you can write it off later, people think that it's like never going to come back to them. So I think a lot of scary things with like renting is you can't write it off as opposed to home buying. You're writing that off. So like you're upfronting the money, but you're getting that back on your tax returns. Like it's basically like putting it into a quote unquote savings account. So you're spending the money, but it's a savings that you'll end up getting back. And people, I think, are scared of that. And most people that are scared to buy homes, and I say this loosely, probably don't have savings or much in a savings. And
let me jump in on that because that's a good point. I don't think people are scared of that. I think they just don't really understand it, Matt, to be honest with you, or they don't believe it. Because when I say, okay, and I got a lot of flack for the example. Where are you going to buy with a $1,500 mortgage payment? Was it a $1,500 rent, a $1,500 mortgage? That was funny, guys. That was. But again, the point is to just explain what I'm talking about, whether the numbers are real numbers that would apply to you or not. The example, the point is the example to illustrate how it's tax deductible. So let's double. Let's make it $3,000. Make it $3,000 today. So if we have a $3,000 a month rent, somebody's renting, paying $3,000 a month versus somebody who's owns, and their monthly mortgage payment is $3,000. That $3,000 a month rent, there's no benefit. The $3,000 a month mortgage payment, let's say out of that $3,000, we're going to use easy numbers. $2,000 of it is the interest on the mortgage part of the payment plus the taxes, okay? It's probably going to be more than that, but we're going to be conservative and say it's $2,000 out of that. That's $2,000 a month, which is $24,000 a year, which is the write-off. That, let's say you make $75,000 a year. Again, these numbers are, we'll say it's 100, okay? Because someone paying $3,000 a month, it probably makes closer to 100 is my guess, okay? Let's say you make $100,000 a year and you're paying $3,000 a month rent. You have no write-off. You're paying taxes on $100,000 a year. In this example of the $24,000 write-off, your taxable income when you do your taxes for that year is now $76,000. That $24,000 write-off gets subtracted from your taxable income. So now you're only paying taxes on the 76. And what a lot of our first-time buyers like, oh my God, James, I got a huge check back because their pay is based on them making $100,000, right? So now they paid that tax all year like normal, just like they were when they were renting. But now come, February, March, April, the following year, they do their taxes. They just got a check back for like $6,000 or whatever the amount is that they overpaid in taxes. They got a refund. I mean, it's a free savings account. How awesome is that? So a lot of people, they just don't understand that, and it's hard for them to wrap their head around because they're so used to rent. And so, yes, I think part of it scares them is because they don't understand it. That's one of the whole reasons I do this podcast, is to help educate people, to help them not be scared of it. We want people to become homeowners.
Yeah, so I saw it on one of your clips that somebody said the standard deduction's so high right now that like people aren't writing off mortgages anymore. What is? Can you touch on that? Does that make any sense?
It's
like, why wouldn't you write it off if you have it?
No, you will.
Yeah,
you will. I mean, it's the interest, the mortgage interest, and your taxes are tax deductible. I mean, everyone's tax bracket is different.
Yeah.
Again, this is that question. I'm gonna save for when we have our CPA on here to get more into that, because obviously I'm not a CPA. I own a house. I write off my taxes. Not all my taxes, because there are limitations to the amount in your taxes. But in these examples, you're writing off all of it in these examples. So again, everyone's tax brackets are different depending on what else they have going on in their taxes. It's all relative. So we're just using very, very basic examples here, which is not going to apply to everyone. And there's some people that aren't going to have the same write-offs because of other things going on. But this is basic. We're talking basic.
I think that's good. I think we touched up on a lot that was definitely I had concerns about, because, you know, like I said, I'm looking to buy. I'm definitely going to use you. Your videos have just educated me through editing them and watching them. It's just good. Like, it's really good. It's informational. So
good.
I appreciate it a lot.
Yeah. I guess that's it for now, guys. I love having these continued first-time buyer conversations with you, and we hope this has been educational. Please put your comments. We are even though we may not be responding to everything because there's a lot to respond to, we are taking notes and using it for this podcast. So thank you, guys. We appreciate it. We'll see you next time.
Yeah, and if you're like, you know, you're like me and you're trying to look to buy a home and you have questions, ask James in the comments, TikTok comments. You know, he'll be responsive if you're a serious person and you're not just trying to troll him. So ask questions, because I'm not going to ask them all. So leave your feedback and comments, and James will definitely, you know, either him and I will talk about it, or he'll have a special person like a CPA come on and talk about the specific question you have. So.
All right, Matt, thanks again for your time today, and we hope this has been educational. Thanks, guys.